Canada's economy appears to have eked out some growth in the second quarter, and it's on track to beat economists and central bankers' estimates for a contraction, suggesting forecasts for a severe economic damage from the trade war may be exaggerated. Some advanced data showing that the industry-based GDP was up 0.1% in June after back-to-back monthly declines of 0.1% for April and May. The Bank of Canada had forecast a 1.5% contraction in the second quarter, but this report suggesting the economy is holding up stronger than expected amid the ongoing trade war with the United States. Lascelles, Chief Economist at RBC Global Asset Management, and he joins us now along with our featured guest this morning, Lincoln Marnick. Eric, what was your reaction to this GDP read?
Yeah, this number is looking a little bit better than expected. Certainly, I would say notably better than the Bank of Canada had assumed as recently as yesterday. You'll recall they came out with a second quarter GDP forecast of a decline of 1.5% annualized, which was quite a weak number, weaker, I think, than many of us on Bay Street had assumed. And it looks like, based on this flash estimate for the month of June, which suggests a 0.1% increase, that, yeah, the economy probably did shrink in the second quarter. So not to underestimate some of the damage that is very much being felt from tariffs and from some other forces as well. But to my eye, at least, and this is just a bit of spreadsheet math done in the last minute or two, but it does suggest as though maybe there was just a 0.2% or so annualized decline. And so still weak, but not on the scale the Bank of Canada had assumed. And interestingly, we are seeing some resilience, in particular on the retail side. So consumers are doing some spending, at least through June.
And obviously, it helps with the retail spending story if people are gainfully employed. We had been talking about the strong labor market numbers for last month, heading into yesterday's Bank of Canada interest rate decision, perhaps as one of the factors for the Bank of Canada staying on hold for now. Tiff Macklem indicated the door is open for rate cuts, but I know that there are some economists that have already sort of thrown up the idea that maybe the central bank is at the end of their easing cycle. I guess one of the key determining factors there is what happens on the trade front. Doesn't seem like we're getting to sort of a clean finish here to that August deadline, and it's hard to know what that ultimately means for the economy. What's your take?
No, I think that's quite right. And so certainly all eyes are on August 1st, and it's relevant for quite a variety of countries, as some have struck deals and some are set to pay the tariff letter rates. And Canada and Mexico are in this curious position of not having a deal. That sounds worse than curious, obviously. 35% rate threatened for Canada. But of course, the twist is that rate only applies to non-USMCA compliant products. Canada is already paying 25% on that. There's a big debate just what fraction of the trade basket gets hit by that in Canada. And if you look just by the letter of the law, what is USMCA compliant, you would say, gee, there's a risk that 40% or so of what Canada sells could be hit by that big tariff. In practice, though, based on what we're seeing with the existing 25% rate, it's only about 5% of what Canada sells that's actually getting hit. And I don't think anyone quite, maybe beyond individual customs officers, quite understands exactly how there is such a profound gap. But if you presume that in the end it is only about 5% of what Canada sells to the U.S. getting that 35% rate, then it's not the end of the world. It's clearly problematic for that sector, and it is a drag, and we are budgeting for awfully cautious growth, if that, over the second half of this year, but it's not the killer blow that a 35% tariff on everything would have been.
And how much of the trade certainty or uncertainty ultimately will impact your opinion on what happens with the economy? Yesterday, the Prime Minister said Canada plans to recognize a Palestinian state at the UN summit in September, following France, but obviously clashing with the U.S. and Israel. And so the U.S. president reacted to that, saying that decision by Canada will, quote, make it very hard for the U.S. to make a trade deal with Canada. And the Prime Minister himself yesterday said it is possible that the trade talks with the U.S. don't conclude by August 1st. So I guess it's still up in the air, it feels like, what happens after August 1st, but the plan has been for the U.S. to roll out higher tariffs after that date. So, like, how big of a wild card is that right now?
Yeah, it is pretty large. We're working on the assumption that there isn't a deal struck in the next, 24 hours. And so we're assuming that 35% rate does apply, but in that limited way that I mentioned earlier. Obviously, copper tariffs, you had some experts on not long ago, and so that's entirely relevant as well. And so there is some extra pain coming, absolutely. We think it will be a challenging time for the Canadian economy. Uncertainty, to your point, has been a real drag in Canada over the first half of this year in a way that actually is more profound than we've seen in many other countries. So it's far from a perfect picture. And for what it's worth, my take on the Bank of Canada would be that I do think that there is probably room for a bit more rate cutting in significant part on that basis. If allowed to abstract out to the world, I would say uncertainty is down significantly on that front. Quite a number of countries have struck deals, including South Korea, just in the last 24 hours or so. We are getting a better sense for where this likely lands. I think just as it happens to be with Canada, we're just not in that position. And it wouldn't surprise me. I mean, maybe there will be some smaller deal in the coming weeks. I certainly hope that there is, but wouldn't surprise me if a measure of uncertainty continued on right through to the middle of next year when it comes time for that formal USMCA renegotiation. That could be the time when we see some of the other U.S. grievances aired and solutions found.
Okay, and then I guess just on the subject of inflation, because again, heading into the decision by the bank yesterday, we seem to be still working off the idea that on some of the core inflation readings that the BOC tracks very closely, that sticky inflation would be a problem in them pulling the trigger on rate cuts if that's something they want to do. But the message was pretty clear from Tiff Macklem yesterday that he's painting a picture of those issues on inflation not running too hot so that he can keep that door open for rate cuts. So if we keep hearing about this sort of lingering inflation, what is the inflation story that you specifically will watch?
Right. And so just starting with the acknowledgement, it's tricky even to say what inflation is right now. Do you exclude the indirect tax, the carbon tax elimination in April or not? The number looks nice right now. It's 1.9. It probably would be closer to 2.5 if we didn't have that one particular political distortion, you might say, interfering. We are expecting a bit more inflation coming from tariffs, but I would really emphasize the point that when a country applies a tariff on another, it hurts both economies. Of course, Canada is grappling with that vis-a-vis the U.S. However, Canada doesn't really get much more inflation unless Canada responds. And of course, I do appreciate Canada has responded, but it's been a partial response. There seem to be a lot of loopholes. I don't think there's going to be a huge inflation jump in Canada. And so we're working on the assumption it's 1/4 to 1/2 percentage point of extra inflation temporarily in Canada. And so not to downplay that, and it does very much complicate the monetary policy path, but I don't think it's going to be a permanent impediment. And so my takeaway is there is significant economic slack. The economy probably does underperform over the next 6 months. We may get a bit more inflation, but it should be, I hesitate to say transitory, but temporary in any event. So I do believe there's room to squeeze out a couple more rate cuts for Canada.